Hello, welcome to Economic and Tax Implications of Trump's Second Presidency. We've just opened up and people are starting to come in, so let me give it 1 or 2 more minutes before we kick this off. Welcome to the Economic and Tax Implications of Trump's Second Presidency. Thank you for attending. Just a couple of housekeeping notes before we get started here. First, we'll send out our slides and the recording of this webinar either late today or tomorrow at the latest. And please feel free to ask questions. You could put them in the box on the right-hand side, and we'll get to them perhaps as we're going along or at the end if we have time. So with that, just a little bit, many of you know us already, but for those of you that might not, just a little bit of background. We've got our consulting and our software side of the business. We've been around for 26 years. Our software is JobsEQ. A lot of our work centers around labor market data and analysis, but we do other things, especially on the consulting side, like economic impact, strategy, diversification plans. But the bottom line is that we're driven by customer satisfaction, and our top priority is excellence in customer services and data quality. Some of the markets we serve are here, and we serve them both on the consulting side and through our JobsEQ software. And here you can see many of the organizations, top consulting firms that use JobsEQ, as well as local and state government agencies and education institutions. One final piece of advertisement before we get on with the content, and that is we have a conference. This year it will be in Nashville in April, and we've got some great speakers from Microsoft, for example. McGuire Woods on the counseling side is going to talk about housing as an economic development strategy. And so I just really encourage you to think about coming to that meeting. In terms of the speakers today, myself, Chris Chmura, the founder and CEO of Chmura Economics and Analytics. I'm an economist, and we're pleased to have joining us Stephen Kimberlin, a tax partner at Forvis. Forvis is a global firm with over 7,000 employees. It's ranked among the largest public accounting firm in the U.S., so we're very grateful to have Stephen with us today. And we're very fortunate that Stephen is our tax accountant, and he is great at taking complex concepts and making them understandable to non-accountants. And so I'm sure that you'll really enjoy his comments here today. In terms of an agenda, first, Stephen's going to talk about 2025, looking ahead to things that could happen on the tax side. He'll talk about the implications of it for the U.S. deficit and the debt burden And oftentimes I get that question during these webinars, so I'm glad he'll be addressing that. And then he's going to take an in brief review of 2024. And then I'll give you a view of Trump 1.0. That is his first presidency. What happened? What was his policies, and what did they do for the economy? And then I'll take a look at what I'm calling Trump 2.0, the economic impact of those new policies that we're expecting. So we'll start with Stephen, who will give us that overview on the tax environment. And then again, I'll follow up with a view from the economic perspective. So with that, Stephen, let me turn this over to you.
Appreciate it. Thank you, Chris, and happy to be here and grateful that everyone could join today. Feel free to stop me if there's any questions. Have some content here today, but obviously happy to take some questions as they come up. But overall, the sort of overall summary of the presentation here today is really looking at what tax items may need to be addressed with this upcoming administration, largely due to some scheduled sunsets. So while we don't have a crystal ball, there are a few items we know that we need to monitor as tax preparers and advisors, and those that are important to both businesses and individuals. So with that, I'll kind of kick off with really the discussion of the bulk of the potential either change or extensions. That really comes from the expirations of a few key items of tax legislation, the largest of those being the Tax Cuts and Jobs Act of 2017, which contained a number of provisions both on the individual and estate tax side that are scheduled to expire at the end of 2025. So in a way, if nothing is done, then we would revert to a lot of the law that was in place prior to the enactment of the TCJA. Or if it were extended, we would have to see what would be negotiated in and what would then be law through either an extender or revision of the law. One thing to put in context, because again, I do have a couple slides on some economics like debt burden. We're not economists. That's obviously Chris's area of expertise. More just mentioning those concepts because a lot of the tax bills are passed through budget reconciliation measures. And given the makeup of the House and Senate currently, where while the Republicans have the majority in both houses, there's not the 60% majority in the Senate needed to break through certain filibusters or approvals. Things like tax updates or extenders may need to be managed through the budget reconciliation process. So as a result, any tax legislation that is developed or extenders that are considered would have to essentially be budget neutral. So that's sort of why we're tying it into some potential economic matters because of that position and sort of needing to examine how these extenders affect the budget and whether or not they can actually enact any of these updates or changes because of how that budget reconciliation process works. So just a quick highlight here. This is just a very simple calculation using a taxpayer with $100,000 income and standard deduction of how they may personally see their taxes change if the entire TCJA were allowed to sunset at the end of 2025. So, for example, this might be their 2026 tax return. You can see here at sort of the various filing positions, whether it be single, married filing, joint, with or without dependents. Generally, for this example, a taxpayer, in all cases, in all sort of filing positions, if the TCJA provisions that are scheduled to sunset were allowed to do so, we would likely see an increase in the tax liability for this individual in various scenarios. So sort of putting that up here, not to advocate for one position or another, but just to understand that it is going to have an impact on probably a wide array of taxpayers, anywhere from sort of the single individual taxpayer all the way up through large businesses could be affected if certain extensions are made or certain extensions are not made, and those provisions are allowed to sunset. Right here, this slide is really a lot of the more significant items from the TCJA that are scheduled to sunset and what the law would revert back to. So I'll kind of run through these. Some are more important than others. Some have gotten, I'll say, a little bit more press than others. So we'll see what they do with them, but kind of have commentary on a few of these as we work through. So the Section 199A QBI deduction, this is a deduction for small business taxpayers generally in a partnership or S corporation structure, whereby they may get a deduction of up to 20% of their business income as a deduction on their personal tax return. Where this is important is currently the top individual tax rate is 37%. But if an eligible taxpayer were eligible for the full 20% deduction, the effective tax rate on that pass-through income, again, assuming it qualified, would be 29.6%. So you can see there that you're saving over 7% on your federal taxes with the use of this QBI deduction. That is, again, scheduled to sunset in 2025. Now, this is an interesting one. We're not sure which way this will go in terms of whether it will be extended or not. Reason being, again, this is going back to the budget reconciliation comment, is that this deduction, generally speaking, could be viewed as a revenue raiser, meaning that if they were to not extend this provision, because it does give this large deduction and it does reduce tax rates on a handful of taxpayers, it could be an item that if they were to not extend, it would be essentially a revenue raiser to help reconcile some of the budgetary concerns through a reconciliation process. So we have a number of clients who receive this deduction, so it's something we are monitoring closely, given where it could fall out of an extension package, because it could be one of the levers they need to pull. But as noted before, for a lot of our higher income earners, it could have a fairly significant impact to their tax bill, over 7% addition to their top tax rate as a result of this deduction changing. The other big one, which was a very big topic, I would say last year, we were gearing up for potentially a lot of estate tax work among our client base. Currently, the estate tax exemption, that is the total gifts and estate tax state transfers you can make before taxed as an estate, is currently for an individual of $13.6 million. That's scheduled to go and sunset to about $6 to $7 million based on inflation. They have not yet pegged that number, but there is a baseline of a $5 million exemption that has increased for inflation. So given the recent inflation we've seen, we're still trying to understand where that may fall, but it could be between 6 and 7 million. Obviously, traditionally, from the Republican side, they have generally favored a higher exemption or no tax in general. So this is one where we were fairly concerned about this potential estate tax exemption being reduced to the lower level, and therefore being an issue for a larger set of our population, a larger set of our population of clients. But we feel like this one could get extended, just given the history of the Republican Party. So this is one, again, we continue to monitor, but chances are we could see this get extended or revised in sort of the taxpayer's favor. The other large one is the tax rate changes. What's interesting is the corporate tax rate has gone down to 21% from 34% prior to TCJA. The corporate rate is actually one that is not scheduled to sunset. When they made that change during TCJA, they made that a permanent change. So currently, the tax rate is 21% on the corporate side. That is scheduled to continue, but there has been discussion by the Trump administration to potentially reduce that further to 20% and potentially enact a separate rate for certain industries, such as manufacturing, that may go down to a 15% rate. So we still monitor that, even though that's not part of the scheduled sunset provisions. We continue to monitor that because we've heard of potential changes to that rate, which would obviously affect our client base, but taxpayers in general. However, on the individual side, the individual rates are scheduled to go up back to their pre-TCJA rates, back to a maximum of 39.6%. So again, top earners may see a 2.6% increase to their tax rates. On this list as well, the other big one we've seen some news is the SALT cap. This cap is the one on your itemized deductions, where currently you can only deduct up to $10,000 of state taxes, that be state income tax, real estate tax, personal property tax. Prior to TCJA, there was no limitation on that deduction. They have talked about this for a long time, considering removing that cap and therefore allowing there to be largely an unlimited deduction on your itemized deductions. This has been kind of popular among, on both sides of the aisle. You've heard this come out of New York, New Jersey, where there are higher tax rates. It did disproportionately affect their constituent base because they typically had higher state tax deductions. So this one has been favorable in terms of likely they would allow this to actually sunset and therefore have this increased limitation. Why I sort of bring that up is that, again, if they were to eliminate the SALT cap, they would potentially have a reduction in revenues, and therefore they may need to use another lever like the 199A deduction to offset that adjustment to the budget. And that's just an example of how they may extend or allow some items to sunset to make the budget work and to make various items within the TCJA extensions work, in a budget reconciliation process. A couple of other credits to consider. One that I'll just kind of highlight here is the new markets tax credit. This is a credit that is available to businesses who sort of invest in certain communities that are designated eligible for this tax credit. That could be made permanent. They could allow it to lapse. We'll see. It is one that we've seen a lot of activity in this space. So we're interested to see what happens with it, but it is one of those where it is a credit. So again, just looking at the mathematics of it all, does it continue to be allowed and make it through? Or is it one that has to allow to be sunset to make the budget process work? But it is one that's being talked about quite a bit. And so this is one we're looking to monitor even further. All right. Again, just a couple comments on the deficit and debt burden. Again, we are not economists, but we're more just highlighting these items in the context of the budget process. Because if they do use the budget reconciliation process to pass tax legislation, the bill does have to be sort of revenue or budget neutral. So a couple of things to consider are, given the budget deficit, sort of given the rising budget burden or the debt burden, could we potentially see these sorts of items be a consideration for how they do enact tax change? For example, if they may look to create a surplus to deal with some of the debt burden issues, does that potentially remove the extension of some taxpayer favorable deductions within the extension package so that they can create this budget surplus? Again, not our wheelhouse here, but it is something that as we consider what the administration may do with tax legislation, is it something that may be on the minds of the lawmakers here and may inform some of the decisions that they make with respect to what aspects that they consider and what provisions they either extend or modify to fit their goals with respect to deficits and the debt burden for the U.S. Okay. There are a few items that are sort of outside of the space of the Tax Cuts and Jobs Act, the TCJA. They were, in a way, part of the TCJA, but they are not scheduled to sunset in the same way. There have been three provisions in particular, more related to business income, Section 174, Section 163J, and bonus depreciation. These are different methodologies in how the R&D expenses for companies, also the interest expense for companies, and the depreciation calculation for companies were modified through the TCJA. They were largely taxpayer unfavorable, and they were fairly significant. So even prior to this administration coming in, there were attempts to address these three items. The latest attempt to address those items was the Tax Relief for American Families and Workers Act of 2024. This act did make it through the House, and it attempted to basically make modifications to these business items and make them more taxpayer friendly. However, while that did make it through the House, it did not make it through the Senate. So this did not end up being made into law. But the reason we highlight it here is because it is something that Congress did try to address even prior to the change in administration. And we expect that the current administration would look to address these items as well. Again, they were very hot topics and they are taxpayer unfriendly. So with that, we would expect there to be some noise around these. So we continue to monitor those as well as the other items. The other one that I'll sort of, maybe two that I'll point out is just briefly the child tax credit. The child tax credit currently is about $2,000 per child. That's scheduled to sunset and go down to $1,000 per child. They are looking to potentially expand that credit and increase the credit. So something to look at, particularly if you have children, may affect your personal situation. But largely, I think individuals are looking for this to potentially be a more favorable or increased credit. There has been discussion of increasing that credit. We'll see what the new administration has to say, what they have to say about that. But up until very recently, there was a lot of talk about potentially expanding that credit program to make it more taxpayer friendly and favorable. But we'll see what will happen now. The other item I'll mention on this list just briefly is, interestingly enough, the U.S.-Taiwan taxation relief. Now, the U.S. and Taiwan does not actually have they do not have a tax treaty in place. Obviously, just from a geopolitical standpoint, they don't technically recognize it. But the reason we bring this up is because of the activity related to the semiconductor industry and the credits given to that industry. There has been talk potentially of looking at some double taxation relief between the two countries to basically enhance that sector and sort of that goal of sort of increasing that investment in the U.S. So while there's nothing there currently, we have heard some noise about there potentially being some more formal taxation relief put in place between the two countries to address that item. So again, nothing concrete yet, but just some whispers that we're hearing, obviously related to the tax code with the large credits given for the investment in facilities to build semiconductors here domestically. So there could be something there in terms of our international taxation. The employee retention tax credit, I'll touch on this briefly. This program has largely sunset. This was the program whereby if you owned a business and you retained workers during COVID, you may be eligible, depending on your facts and circumstances, for a tax credit against some of that payroll. The reason we mention it here is because there was a moratorium on the review and issuance of those refunds late in 2023. And they talked about ending the program entirely in January of 2024. We have started to see the IRS review these credits applications and start to send out new refunds. So again, nothing to new to report here. Just wanted to bring that up, that is a very large program that was enacted during COVID that is starting to sunset. So it's one that we inform our clients in our networks about, just because it will be a large change for them, something they've dealt with for a number of years that is starting to sunset here. All right, and I believe this is the last item. Let me just do a double check here. Yep, this will be sort of the last item I cover in detail, but wanted to talk about sort of the effects on the Chevron case. If no one had been following, this was the case that sort of overturned sort of the agency's ability to interpret law. And where this comes into play on the tax law is that, do we have to follow the IRS's interpretation and their statutes related to the tax code that's enacted? Part of what we look at as tax practitioners is obviously we look at the tax code, but then we also look at the IRS's regulations and their private letter rulings and other documents that they produce. With the overturning of the Chevron doctrine, that puts into question whether or not we can actually rely on those sources of authority. And potentially, we may need to rely more on court decisions for how we interpret and enact some of the tax legislation that is given to us. So it's something that we monitor and consider because it affects how we do our job and how we apply the law and obviously other sources of authority to our clients' tax situations. So we bring that up briefly just to mention that could change a little bit how we practice and how we interpret and apply some of these, because we may not be able to rely on some of the IRS's positions because of the overturn of the Chevron doctrine. Maybe a couple minutes. I'll just briefly mention here. The IRA, which is the Inflation Reduction Act. The reason I mention this is largely an act that gave a lot of different tax credits, various tax credits, particularly energy tax credits. And I think Trump has come out and said that he's not in favor of some or all of these. So we could see some activity here where some of these credits are appealed, or parts of the IRA are potentially repealed by the current administration. However, just a note here, not to get political or anything, but what's interesting about that comment is that you can see by this map here that there are a number of Republican-led congressional districts that actually have some of these clean energy investments and potential credit projects in their districts. So it'll be interesting to see what sort of discussions there are among the party, given Trump's sort of position on some of these clean energy credits, but how it's actually been utilized by some of the constituents in Republican-led districts. So we haven't looked too much into this matter. It's just kind of an interesting policy discussion once you consider kind of both sides of where the sort of president may be versus where some of the members of Congress may be, and how it affects their constituents. So there could be a lot of noise and discussion around the IRA, particularly their clean energy credits. But we're going to sort of see this discussion back and forth given some of the stakeholders here with these clean energy credits. All right, well, Let me know. I believe that brings me to the end of my slide. If there are any questions, feel free. I'm happy to take any questions. Otherwise, if there's nothing here, Chris, happy to turn it over to you for your section.
Okay. Thanks, Stephen. Yeah, and then we will see if there's questions at the end, but very good overview. I'm sure that all these policies are going to affect many of us personally as well as our organizations, so we appreciate that heads up. The one thing I think that's going to be consistent between, well, many things between your presentation and mine, the other consistent thing is that there are a lot of things up in the air right now, and we don't have all the answers yet, but we're getting information in quite quickly. Okay, so first I want to look at Trump 1.0 policies. What happened in his first administration, and his policies generally supported growth. He reduced regulations. Many of those were in the energy and finance industries. He decreased taxes, as Stephen showed us in detail, for households and for businesses. He encouraged reshoring businesses. He increased protectionism to some degree. And then toward the end there, he had a very quick COVID response with the Operation Warp Speed, the public-private partnership, which may give us an idea of how he may put together some partnerships for saving money as we go forward. So that, as you know, allowed us to see a vaccine created in record time. Okay, so what happened to the economy because of these policies? Here we're looking at real GDP, and I've put a box around the Trump administration. And real GDP grew at or above potential during his first administration, which ended with COVID starting. So potential is around 2%, and if you look closely, you can see the economy growing around 2.5%, and so that's a fairly good pace of growth. The economy, with the last 3 years of the president's administration, was during the longest expansion that we'd seen in history. That expansion went on for 128 months, and of course, COVID ended that expansion. But as you can see, because we did have the vaccine, we saw a fairly quick rebound that was facilitated by that vaccine. And again, that may be an example of how that is the COVID vaccine with the public-private partnership may be an example of what we're going to see more of during this second term. Here you're looking at investment in structures and equipment. So during the Trump administration, you can see that those investments went up pretty significantly. By reducing taxes, by increasing business confidence, you encourage businesses to invest in plants and equipment. That leads to productivity gains. That leads to living standards going up for people in the economy and poverty rates going down. We saw durable goods come out today. It's a volatile series. But one thing that we economists look at very closely is the component of durable goods that are non-defense capital goods. So non-defense and their capital goods, such as plant and equipment. And we saw that increase a 0.5 percentage point in December and almost 1 percentage point in November. And so that's a sign that businesses are in this economy right now being pretty optimistic. And also that non-defense capital goods excludes aircraft. It's a component that's used directly to measure part of GDP. And another thing that we saw during the Trump administration is that we actually saw growth in manufacturing employment. If you look at 2017 on, some pretty significant growth. Prior to 2017, it was fairly flat growth. We came out of COVID, and after catching up to the pre-COVID numbers and getting a little higher, for the last 3 years or so, employment in manufacturing has been flat. And what Stephen alluded to, the fact that there may be a separate tax rate for manufacturers that stay here in the U.S. or bring onshore from the U.S., a lower manufacturing tax rate of 15% could cause us to see a similar trend as we did during the Trump 1.0 period. So now moving ahead to Trump 2.0. what will his impact be? And in general, his policies should encourage growth, but some might ignite inflation. So, as with the last time, deregulation is a big positive for businesses to encourage growth. We see more business investment. We see more expansion in hiring because they don't have to spend as much money filling out forms, and with regulation, things get done. Deregulation, things get done quicker as well. As Stephen has talked, we're a little bit worried about revenue budget neutral and what will be in the new bills and what won't. But it looks like if we see an extending the tax credits for consumers, we'll see increased consumer spending, extending the tax credits or even decreasing them for business, and we'll see business spending increase. And then you've got DOGE. So the Department of Government Efficiency is expected to decrease government expenses. So again, that will help significantly on getting us to that revenue budget neutral and allowing the administration to reduce taxes or keep them low. Reducing the federal deficit is part of what will come from the DOGE. And I put a question there about what's the potential impact, because there's a lot of cross currents. How much does the deficit go down depends on things like how much is the economy going to grow? How much are we going to see productivity be enhanced? And then what Congress pursues in terms of some of the things that Stephen pointed out to us in terms of the things that are on their plate right now. I put a question mark as well around tariffs, because we didn't really see inflationary impact with tariffs the last time. And some of you may be saying, but yes, we were in a low inflation environment during that time. And that is true. So the Fed will clearly be watching that closely. Last time we saw this during COVID. And if we do have tariffs, we may see supply chain disruptions. Typically, historically, when there is a tariff, the business passes it on to the consumers. So that would lead to inflation. And we're questioning to what degree is Trump just using this as a bargaining tool. So he'll talk about it, but it won't really happen. And Colombia just this past week was a great example of that, using tariffs as a bargaining tool because they would not accept the immigrants that he was sending back to the country. And by putting on the potential tariff, that changed that situation. And then immigration, I put a question mark there on, is it inflationary? That depends on to what degree it happens and to what degree those jobs that are vacated by immigrants will be taken by U.S. citizens. But it's often thought that these are low-paid jobs like construction and ag workers. And so the thought is if they are deported, we're going to have to see prices or wages going up. And that's not really clear yet to what degree that will happen. The last time Trump came into office, there was some concern because with the border wall, we weren't going to get as many people coming in from Mexico to take construction jobs and ag jobs. And so we did some analysis along the border and using our Jobs EQ wages and job postings, and did not see a perceptible rise along the border because of the change in policy there. But really, we need to think broader about immigration. It goes across all occupations, not just low-income occupations. And so this is one area where we do need new immigration policy. So now I'm showing a chart that goes all the way back to 1820, and we're looking at the immigration over that time. And then this goes through 2002, but I'll bring you up to date on the next slide. You can see that during different periods of time, we had immigrants coming in from different areas. Like at first in the 1820s through 1890, they were mainly from Northern Europe. In the next phase, in white, they were from Southern Europe and Eastern Europe. And then in blue, you see them again from Western Europe. And now, most recently, from Asia and Latin America is where we're seeing most of the immigrants coming. So we did have the Immigration Act of 1924. And if you can look and see in the 1900s how much immigration, the number of immigrants was rising. and it was based on quotas. So, for example, only X number of people could come from Poland, or X number of people from Cuba, or X number of people from Mexico. And then in 1965, that was changed so that the origin quota was dropped in favor of immigrants that had relatives or requests by employers. That really drove the immigrants who were coming in. But this is something that many different presidents have tried to tackle in terms of we need new legislation, and it just hasn't happened yet. But now, giving you just the last few years, going back to 2010, and on this chart you can see it broken out by the type, the foreign-born, what they come in under. So you could see those coming in under humanitarian migrants, the dark blue, really rose significantly in the last administration. And then the others, temporary migrants in orange. You see students in the light blue, permanent immigrants there at the bottom. But again, this is something that that clearly, when the border wall is closed, we've already seen a decrease in illegal immigrants. It could have an impact on wages. This is something I'm sure that the Fed is watching closely. But if nothing else, as we move forward, I'm sure the top humanitarian migrants section of the immigrant chart, the numbers coming in from that sector will go down significantly. So now, as we're thinking about the economy, looking ahead, what will happen? So a good way for me to summarize the potential path of the economy is to distill it down to Fed policy. So the Federal Reserve can only affect the federal funds rate target, and that's the rate that banks use to lend to each other on an overnight basis. But then that will trickle through the curve, and so the 3-month bill, for example, if the Fed lowers the federal funds rate, it will lower the 6-month, and then at the long end of the curve, the 10-year and 30-year is more dependent on inflation. But here you can see we've got a most likely scenario that's in blue. The gray is history. The alternative forecast is in orange. And we did these forecasts about a couple of weeks ago. And so we like to present, this is what we think will happen. And if that doesn't happen, then here's an alternative that could happen. Interesting, 2 weeks ago, most likely was the most likely, but I'm thinking now, given everything that we're seeing coming out of the administration, the alternative forecast, the orange forecast here, is more likely than we're showing the blue forecast. So in the most likely forecast, we had the federal funds rate dropping 3 times this year, 75 basis points, or last year it dropped 100 basis points, or 1 percentage point. And the reason why we're continuing to see it drop is because we're seeing inflation that's still a little bit above their target, which is 2%, and we're seeing growth that is modest. And you'll see that on the next couple of charts. But in the alternative forecast, growth is faster, and inflation is slightly higher. And for that reason, the Fed does not change the federal funds rate at all. It stays solid over the entire period. That is, no change. It remains flat over the entire period. So consumers make up about 2/3 of the economy, so they're very important. On this slide, we're now showing you historical data in 2020 and 2023. 2024, you may say, is over already, but some of the data have not been released yet, and so that's why we still have it as a forecast, but the 2 different forecasts are very close. The most likely is blue, but again, it's the alternative forecast that I believe at this point in time will come to pass for 2025. So in 2025, consumers, because of tax cuts, are more optimistic. They have more money to spend. And so we see consumers continue to spend at about a 2.8% rate compared to if we have a slower growing economy without the Trump policies, 2.2% overall consumer spending. In terms of business, real non-residential investment expenditures, and again, that's spending on equipment and on structures, on plants, new buildings. We saw some strong growth in 2022, still coming out of the COVID period. strong growth in 23, slowing down to around 4% in 24 under the alternative forecast where Trump's policies pass and businesses are optimistic. We see 5% growth compared to the non-Trump type policies, which you have growth around 3%. And remember, durable goods that just came out this morning are pointing more toward this 5% growth rate this year instead of the slower 2.8%. So again, we're starting to see things happening in the economy from some of the policies. So overall GDP, again, in 22, 2.5%, 23, 2.9%. This year, fourth quarter GDP has not been released, but we're expecting overall for the whole year, it'll be around 2.9%. In 2025, just to give you a sense of if Trump policies are working, we could see 3.6% growth compared to, say, pre-Trump policies at 2.5. 3.6% would be very strong growth because potential right now is around 2%. So that would be a very strong economy with good job growth, good employment growth, and unemployment staying at a fairly low level. So with that, some of our conclusions. From Stephen's side, tax legislation expected to address some or all of the scheduled Tax Cuts and Jobs Act when that sunsets, if that sunsets, and also tax legislation is possible to address recent changes like the Inflation Reduction Act and our new administration agenda. So we're, again, closely watching that, but even since we're just in the second week of his administration, we are getting a lot of information that's causing us as economists to reassess our forecasts. And so we will continue to assess our forecasts as Trump rolls out his policies. The timing and content of the budget is very important. Will it be one bill or two bills? And as Stephen talked about, to what degree will some things be left out from the tax cut perspective to offset and make the budget work? We're assuming that the Federal Reserve will be closely watching the tariffs and immigration trends for the inflation impact. So they are very data dependent, and I'm sure immigration trends and inflation will be two of the things that they are very closely watching. Before we take questions, just wanted to remind you, those of you that haven't been on our webinars, we produce a weekly economic update. And if you'd like, you can subscribe to it. It's complimentary, and it comes out every week. We provide you information on the data that came out, what it did for the economy, some information on Fed speeches, will that affect the economy, and then a forecast as well as a table showing you some of the financial data that came out. So with that, we are available to answer any questions. And let me take a look here to see if there are any out there yet. Does anyone have any questions regarding Stephen's overview or my outlook here for the economy? We have just a few minutes left. All right. Well, if we don't, then this slide deck will be available soon, and we will send out a tape. We appreciate your time, and please get back with us and let us know if there are any other topics that you'd like us to cover over the year. Thank you, and have a great afternoon.